Good evening, everyone. A very warm welcome to all the Embassy REIT's first quarter FY2024 earnings conference call. Currently, all participants are in a listen-only mode. Our speakers will address your questions at the end of the presentation during the question and answer session. As a reminder, this conference call is being recorded. I would like to introduce your host for today's call, Ms. Sakshi Garg, Investor Relations Manager of Embassy REIT. Ma'am, you may now begin. Thank you.
Thank you. Welcome to the first quarter FY2024 earnings call for Embassy REIT. Embassy REIT released its financial results for the quarter ended June 30, 2023, a short while back. As is our standard practice, we have placed our financial statements, earnings presentation discussing our performance, and a supplemental financial and operating data book in the investors section of our website at www.embassyofficeparks.com. As always, we would like to inform you that management may make certain comments on this call that one could deem forward-looking statements. Please be advised that the REIT's actual results may differ from these statements. Embassy REIT does not guarantee these statements or results and is not obliged to update them at any time. Specifically, any financial guidance and pro forma information that we provide on this call are management estimates based on certain assumptions and have not been subjected to any audit, review, or examination procedure. We are cautioned not to place undue reliance on such information, and there can be no assurance that we will be able to achieve it. Joining me today are Arvind Maya, our CEO, Abhishek Agrawal, our CFO, and Ritik Bhattacharjee, our CIO. We'll start off with brief remarks on our business and financial performance and then open the floor to questions. Over to you, Arvind.
Thank you, Sakshi. Good evening, and thank you all for joining us to discuss our Q1 results. To start with key highlights for the quarter, we leased a total of 1.1 million square feet, delivered a NOI growth of 9% year over year, and announced distributions of rupees 5.38 per unit. In addition, based on our Q1 performance, our existing healthy pipeline, and considering a clearer interest rate outlook, we have provided guidance for the full year FY24, which Abhishek will take you through shortly. On the macro front, India has emerged as the fastest growing large economy in the world, and its stature continues to grow as a real alternative to China. Along with this, moderating inflation levels and a pause in policy rate hikes has improved the general business and market sentiment, as well as reinforced the growth stance of the government. The same positivity is also reflected in the Indian commercial real estate market, where demand remains strong from premium office spaces. This is in stark contrast to many developed office markets and is largely supported by two factors. First, the growth of global capital centers, or GCCs, in India is currently driving the new demand. By leveraging the Indian skilled talent and the associated cost arbitrage, these global companies continue to set up and expand their offshoring centers in India. As per recent industry reports, 115 such centers are expected to be set up every year in this decade, employing 2.6 million additional headcount. This will be a key driver for the new office space requirement of over 450 million square feet expected over the next 10 years. Also, moving up the value chain, these GCCs are emerging as centers of excellence and innovation and are driving product development in multiple areas such as AI, cloud, engineering, and data analytics. Second, the physical office attendance continues to improve in Indian office markets as compared to the West, where remote working is still quite prevalent. Even in our properties, back-to-office numbers are rising steadily. It is also encouraging to see the recent commentary from multiple industry leaders regarding their updated back-to-office strategies and their continued focus on getting their employees back to the offices. With this backdrop, let me move to our portfolio and start with the leasing performance for Q1. We leased 1.1 million square feet across 22 deals, including 407,000 square feet of new leases at 68% re-leasing spreads. We also pre-committed 448,000 square feet in our under-development projects at a premium to market rents and renewed 209,000 square feet leases at 15% renewal spreads. The leasing demand was primarily driven by GCCs, contributing to over 71% of our total leasing. In terms of sectors, besides technology occupiers, BFSI, consulting, engineering and manufacturing firms led the demand. We also noted a strong trend of expansionary demand with over 80% of the new or pre-leasing by our existing occupiers. Also deviating a bit from the last quarter's trend, a couple of large-sized deals got signed in Q1. Embassy Manyata contributed 61% of the total leasing this quarter and its occupancy touched 91%. This asset has been going through a positive churn in terms of occupier mix, and we've been able to increase its in-place rentals by around 20% in the last 18 months. So now our two largest markets, Bangalore and Mumbai, are at greater than 90% occupancy levels. Factoring the 702,000 square feet of exits during the quarter, primarily from IT service occupiers, our Q1 occupancy stood at 85% for the overall portfolio and 87% on a same-store basis. Of the 5.1 million square feet current vacancy, around 67% is concentrated in Pune and Noida, significantly smaller markets for us. Hence, on a value basis, this Pune and Noida vacancy translates to only 5% of our portfolio value. Looking forward, we have a promising leasing pipeline of 2 million square feet for our operational portfolio as well as our under development projects. On the SEZ front, we are still awaiting regulatory clarity on the SEZ bill amendments and we continue to be hopeful for a resolution soon. In the meantime, we continue to work on what is under our control. We leased 0.5 million square feet of SEZ space this quarter to existing SEZ occupiers looking to expand. We are in the final stages of denotifying our existing 0.4 million square feet D3 building in Embassy Manyata. We have already leased 41% of this building at 210% releasing spreads. With a pipeline of another 225,000 square feet, we are hopeful to fully lease this building by the end of the year. This is a perfect example of the strategy that we continue to follow to denotify any completely vacant SEZ buildings where leases get expired or where we are able to relocate existing occupiers. We have identified another such building in Manyata totaling 0.8 million square feet, which we will look to denotify within this financial year. With this, our current SEZ vacancy stood at 15% or 3 million square feet, seeing an improvement from the last quarter. Also, the non-SEZ vacancy for our portfolio is 10%, excluding the new buildings in Pune delivered last year. This non-SEZ space has good traction and we are confident to lease up the same. Moving to our development portfolio. Our development pipeline totaling 7.9 million square feet is a key organic growth lever for us over the next 3 to 4 years. With a total committed capex of 4,000 crores, these projects are expected to add approximately 900 crores annual NOI upon stabilization, resulting in a very attractive yield. 3 projects totaling 2.1 million square feet are due for delivery this year across Bangalore and Noida. Of this, the 1 million square feet M3 Block A in Embassy Manyata is awaiting occupancy certificate, which is expected by next month. This block is already 45% pre-committed with a healthy pipeline for the balance. In addition, 0.4 million square feet of Embassy Business Hub is on track for delivery next quarter and is almost fully pre-leased. Overall, over 90% of our total development projects are in Bangalore, which continues to lead India's office absorption. Around 1/4 of the total developments are already pre-committed to leading global companies, and we are building a strong pipeline for the remainder. In terms of key upgrades, we have completed the refurbishment of 0.2 million square feet Block K at Embassy Manyata. Around 72% of this block has already been leased at 215% releasing spreads. For the remainder, we have a healthy pipeline of over 100,000 square feet, and we expect to fully lease this building by the end of this year. Lastly, on our hotels, the strong rebound in our hospitality business continued with a 53% occupancy, a 30% year-over-year ADR growth, and an EBITDA of 40 crores in Q1. We are extremely proud to see our unit holder register crossing 85,000 as compared to 4,000 at the time of our listing and around 47,000 at the same time last year. We particularly welcome the expansion of domestic, institutional and retail investors in our book. Also, to build the understanding and awareness of the REIT product, we have undertaken multiple education initiatives for retail investors across India and we are happy to see increasing recognition of the long-term potential of the product. Finally, I am pleased to announce the elevation of Abhishek Agarwal as the CFO of Embassy REIT. Abhishek was designated as the interim CFO of REIT in May 2022 and is known to all of you. I wish him great success in his elevated role, and with that, over to Abhishek for our financial update.
Thank you, Arvind, and good evening, everyone. Let me take you through the financial updates for the quarter. Revenue from operations grew by 10% year-on-year to rupees 914 crores. This was mainly driven by new lease-up at attractive releasing spreads, contracted rent escalation, and a ramp-up in our hotel business. This was partially offset by the impact of exits in our office portfolio. Net operating income grew by 9% year-on-year to rupees 738 crores, in line with the increase in our revenue from operations. Our office NOI margins stood at 85%, demonstrating our scale and efficiency. Net distributable cash flows grew by 1% year-on-year to rupees 510 crores. The year-on-year increase in our NOI contributed positively to our distribution, which was primarily offset by an increase in interest costs as well as other working capital changes. Further, we have declared Q1 distributions of rupees 510 crores or rupees 5.38 per unit, making this our 17th quarter of 100% distribution payout. Moving to our balance sheet update. Our balance sheet remains best in class with a 7.3% in place debt cost and dual AAA stable credit ratings. We remain focused on active capital management and interest cost optimization. In the last 2 months, we have successfully raised 2 NCDs totaling rupees 2075 crores at an average rate of 7.8% to refinance bank loans which were due for repricing. In this refinancing, we achieved a 120 basis point spread over GSEC, our lowest ever. We also secured 146 basis points pro forma savings as compared to the expected rate on repricing of these loans. Of our debt book totaling rupees 15,350 crores, rupees 4,100 crores of NCDs are due for refinancing in the latter half of this financial year. Considering the continued pause in interest rate hikes by RBI, as well as the rate achieved on our recent debt raise, we are confident of refinancing these at industry-leading rates. We will also look to raise debt across different tenures to continue staggering our debt maturities. Lastly, I will update on the outlook for the remainder of FY24. Given that more clarity has emerged on our leasing pipeline as well as on the trajectory of market interest rates, we are providing guidance for the full year FY24. We expect our NOI to be in the range of rupees 2924 crores to rupees 3136 crores and our distributions to be in the range of rupees 20.5 to rupees 22 per unit. Our outlook is based on the following key assumptions for the full year. Considering the market outlook and our pipeline, we have assumed a total lease-up of 6 million square feet. This comprises of 4 million square feet of new lease-up, including new building deliveries planned in FY24, 0.7 million square feet of renewals, and 1.3 million square feet of pre-commitments. With this, we expect our same-store occupancy to end up marginally higher year-on-year. We expect to achieve contracted rent escalations of 14% on 6.7 million square feet leases during the year. We expect continued improvement in our hotel business, both in terms of occupancy and ADR, and have factored in a 60% year-on-year increase in our hotel EBITDA. Finally, we have assumed our overall interest cost for the year to increase by 15 to 18% year-on-year. 2/3 of this increase is expected to be due to overall increase in rates, and the remaining 1/3 due to the additional interest costs related to our new deliveries. Also, while we do not want to give any specifics beyond FY24, we believe that this year will likely represent the bottom of what has been an eventful first 5-year cycle for Embassy REIT. The key drivers for this will be, first, we expect leasing demand to pick up given how optimally positioned India is, both from talent availability and cost arbitrage perspective. Additionally, the new supply that we are developing in Bangalore will provide further impetus to our leasing, particularly from GCCs. Lastly, we also expect the rate cycle to moderate and have a positive impact on our cost of funding. All of these factors should contribute to the start of a period of secular growth for Embassy REIT. With this, let's now move to question and answer, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Dayal from Bank of America. Please go ahead.
Great, thanks. I have 2-3 questions if I could ask them in one go. The first one was around the swell in your pipeline. I'm assuming that a lot of this comes from GCC, given the comments you just had. So wondering if, even for the pipeline, the observation is similar, that bulk of it is coming from existing companies that already have GCC operations and they are planning to expand? Or do you think this is coming from, new companies wanting to set up shop in India? That's the first question. My second one was, any additional color on whether IT services contribution is bottoming out for the business? I think last quarter you mentioned that it's down to about 15% of the portfolio. And then, the last one is on the delta between NOI growth and distribution. So I do get it that, interest expense is one component of it, but, there ought to be some other factors as well. Wondering if it is working capital and, what exactly is contributing to this increase in working capital versus earlier. Thank you.
Thank you, Kunal. So let me take the first one, then hand it over to Abhishek in relation to the NOI to NDCF walk. So firstly, in relation to pipeline, I would say it's a combination of a couple of things. One, as we mentioned, the pipeline is significantly coming from GCCs. And I would say it's a combination of existing GCCs who are looking to expand, some of them expanding quite significantly and some of them marginally, as well as a few new, guys who have entered into India. So it's a combination of both, which is there in the 2 million square feet of pipeline. Secondly, in relation to IT services, the numbers, first of all, is largely similar. 15% is now down to 14% because we did have one big exit. But I think in terms of overall, the way we are seeing going forward, probably it might be a good statement to make probably that it's bottoming out for the simple reason that while overall business is down, if you look at it from a real estate point of view, the message which is coming from almost all leaders is very clear that they want people back in office. That's number one. Number two, we were picking up a data point from a recent research report which said that the last 3 years hiring, only 27% of that has got converted to lease space, which basically means as people come back, they will definitely need more space. But having said that, probably the expansion of space might take a little bit more time for the business to stabilize, but in terms of downside, it might be a good statement to make that it is bottoming out. So these are the 2 quick responses to the first 2 questions. With that, why don't I hand it over to Abhishek for the third one?
Yeah. So, Kunal, you rightly picked up that the delta, actually there are 2 major components. One is the interest, as you picked up. The second one is the non-cash NOI. Why this will come is because the 6 million square feet leases that we will do, on that then there will be gap between the LCDs and the RCD, because of which there will be non-cash revenue which will come during the current year. And there will be right portion of this working capital, which is normal in the business who have timing gap in collection. And
Got that. All right. Thanks a lot, Arjun and Abhishek.
Thank you.
Thank you.
The next question is from the line of Puneet from HSBC. Please go ahead.
Thank you so much. My first question is, just on your tenant, it seems IBM, the share of space from IBM has gone up again. Can you talk a bit more about what kind of space are they taking? They seem to be little cost-conscious customers earlier.
I think, Puneet, in terms of new take-ups, let's say in the quarter there are none. The percentage change will just be a change in composition of the other tenants.
Yeah. Okay, because their own share has gone up from 6.5 to 6.7. That's the reason for the question.
Yeah, so it's because of change in composition of the other top tenants. But just from a little bit of way ahead, if I can give some perspective, I think from a return to office point of view, based on discussions, they have been pretty clear. While they had encouraged complete work from home, they've changed it. There is significant return back to office. So overall, from a business, while we are seeing some offshoots, I would say it's still early.
Okay. Second, on your leasing, while Manyata seems to be improving a bit, there hasn't been any material improvement in leasing for Quadron, which I thought is non-SEZ and should lease out well. And similarly, if you can comment a bit more on what's happening on Galaxy and Oxygen as well.
Sure. In terms of Quadron, it's a SEZ space, Puneet.
Okay, so my bad.
That's one factual change. And just from a leaser point of view, considering all the infrastructure which is happening in and around the space, largely the metro, there is a bit of situation in terms of traffic, etc. So from a medium to long-term perspective, we are pretty confident of that park. We've already done the necessary upgrades. So that's on Quadron. In terms of Galaxy, we did have one large IT services tenant exiting this quarter. That's the reason why you see occupancy dipping. But this is a non-SEZ space, and there is good amount of traction on this asset, and a large part of the pipeline which is there is also coming from this asset. So we're pretty confident of leasing up this space.
In Oxygen?
In Galaxy. So Oxygen is a SEZ space. So Oxygen, I would say, from an overall demand perspective, is still sluggish. This, I would say, is an asset which we categorize similar to Quadron, where we'll have to wait for some overall infrastructure upgrades to be done, including the new airport. But just to give you a different perspective, if I were to take both Pune and Noida assets together and take the vacant space of these two assets, put together, they're only 5% of the overall value. But yeah, on a, just to sum it up, these two assets will take some time for the lease up to improve.
Understood. That's helpful. My last one is on the refurbishment cost. So there seems to be a lot of refurbishment that you're doing. How would those refurbishment costs be treated from distribution perspective and also from P&L perspective?
Yeah, so the refurbishments are largely funded by debt, which has typically been our strategy around all capex. And these refurbishments, at least in the case of Manyata, which we've done, have provided us significant returns, because you would have seen that both B and K blocks, we've been able to get releasing spreads in excess of 200%.
Right. And what kind of refurbishment expense should one run with for next few quarters?
So the way to look at it is, based on historical evidence, these refurbishments can range from 1,000 to 1,500 rupees, depending on the age of the asset and what are the upgrades which are required. So one, other than the two which we've already disclosed, I did mention in my remarks that we have another building. So we do have another IT services tenant which is expected to vacate later in the year, which is part of our expiries. So that's one full block in Manyata, and we would be taking up refurbishing that building similar to D&K, and we expect similar results in terms of the releasing spread on that building.
Understood. That's very helpful. Thank you so much, and all the best.
Thank you. The next question is from the line of Murtuza Arsiwala from Kotak Investment. Please go ahead.
Yeah. Hi, Arvind. Hi, everyone. A couple of questions. One is, typically, how much time is it taking for you to denotify? You've had some sort of building-wise denotification. So how much time is the entire process taking? That's question number one. Question number two is on the hotels business. Generally, when we look at other hotel companies out there, they're showing pretty robust numbers in terms of occupancy. Your room rates obviously have increased, but anything that's holding back on the occupancy? And the third is a more generic one on the common area maintenance, the facilities management business. Typically, what's the kind of margins that you're making?
Got it. Thank you, Murtuza. Time for denotification, I think we've discussed this in the past, but let me take Bangalore as the right example because this is where we will be undertaking more denotifications in the time to come. What our experience in the recent building of D3, while it's, let's say, 2 weeks away, it's taken us about 5 months to denotify the space end to end. There are a little bit of learnings which we have taken from this denotification, which should compress this time a bit. So overall, I would say 4 to 5 months is what we need to denotify buildings in Bangalore. Pune, the Hudson Ganges, which we did denotify, took much more time because the process was more difficult. If you were to replicate that in Pune, probably we could again learn from that experience and reduce the 12 months to, it will be difficult for me to give a exact time frame, but definitely we can look at some reduction even in Pune. Noida is one area, as we mentioned, it's taken us a lot of time. On the overall construction as well, we have gone a little slow considering the demand. So we will undertake that denotification as and when the building is coming up more close to completion. So that's on the denotification. In terms of hotels, honestly, the two Hiltons, which is Embassy Golf Links and Manyata, are doing phenomenally well. Golf Links is upwards of 60%, which is in I would say in similar range as compared to Sphere Hotels, but the ADRs are much higher. Similarly, Embassy Manyata, it's much around 52%, right? Some most recent months about 60% as well. So that also, when you look at it from a park perspective, the occupancy is still not significantly up because the IT services are still there. So we believe that this will pick up significantly in the next few months. The only hotel which kind of brings the average down for us is Four Seasons. That is one focus area for us as we look into the year ahead. We are working closely with our operator, which is Four Seasons, to look at more initiatives in relation to marketing as well as corporate tie-ups, but this is a space to watch out for, specifically for us as management. Lastly, on CAM, Abhishek, do you want to take it?
What actually happens is we have 20% markup to all the costs that we spend on CAM. Does that answer your question?
Murtuza, are you there?
I'll just move on and get back with you.
Okay, operator, I think we can move ahead.
Mr. Murtuza, you may please go ahead, sir, if you can hear us.
I can hear you guys.
Okay, sorry, we lost you. I don't know whether you got answers.
No, I got my responses. Thank you. I was saying thank you, but I don't know why it wasn't audible. Thank you.
Okay, great.
Thank you. Next question is from the line of Vishal Parekh from Kotak Investment. Please go ahead.
Hello.
Go ahead. Yeah, go ahead, Vishal.
Yeah. So on the refurbishment cost, I had one query. So the new block which you put for refurbishment, approximately I think 1,250 per square feet seems to be the cost which you have indicated in the CAPEX schedule. So does that include denotification cost as well? Because I think that particular building is SEZ and occupied by one client which is expected to vacate.
Yeah, Vishal, it doesn't include the denotification cost because that's a number which could vary depending on how the assessment goes with the local state authorities. So we've not factored that cost.
Understood. And on the statement of maintaining a similar occupancy going ahead, considering that particular tenant is moving out and you all will have to denotify that particular tower, would you still be able to maintain similar occupancy basis the pipeline which you have in Manyata?
So the way to look at it, Vishal, is this tenant is expected to exit in the next quarter. Of course, there would be some time gap by the time we fill up this space. So on a quarterly basis, you could see this number going down. But when we end the year, we're pretty confident that on an overall portfolio as well as Manyata, we will be marginally higher, including same store. We should be marginally higher than what we are as of June.
Understood. Thank you so much.
Thank you. The next question is from the line of Pritesh Seth from Motilal Oswal. Please go ahead.
Yeah, sorry. Thanks for taking my question. Just one question to clarify. So out of the 1.3 million square feet that's expected to expire in Embassy Manyata this year, 0.8 million square feet is the refurbishment tower, if that's correct. And rest, any sort of negotiations that are happening for the rest of the 0.5 million square feet, if you can highlight that.
I think in terms of 0.8, you are absolutely right. That's part of the 1.3. The balance, without getting into specifics of Manyata specifically, I think we have indicated the overall renewal number for the full year. Of the balance expiries, we expect 0.5 million square feet to be renewed of the balance, and logically the balance should be most likely exit.
Sure. And just in terms of refurbishment, I think you answered in a way in the previous question. How much time it takes for you to refurbish the tower and then release it based on your experience in D3?
So the D3 and K have taken similar time of around 9 months. If you look at it, K block is 70% leased by the time the building was refurbished. D3 is around 40% plus released, with both these assets having significant pipeline. So you could say another 3 to 4 months or 6 months max for it to be back to fully leased.
Sure. And with this floor-by-floor denotification, given where your portfolio stands, especially Embassy Manyata, where we are looking to, denotify whole tower, will this floor-by-floor denotification help you in your other assets? I'm not sure, if there is any scope for, doing that in other assets. So if you can help.
There definitely is scope for doing floor-by-floor in other assets and Manyata. So we will still be having vacancy across our parks, which is not necessarily full buildings, and not necessarily we'll be able to relocate some of the tenants to make it fully vacant. So 100% the floor-by-floor denotification is going to benefit us significantly across all our parks. Sure.
And if you can just, help me with your current SEZ vacant space. I'm not sure if I've missed that, if you mentioned earlier.
Yeah, the current SEZ vacancy is around 14% for the entire portfolio.
Got it. That's helpful. Thank you. All the best.
Thank you.
Thank you.
The next question is from the line of Pradyuman Chaudhary from JM Financial. Please go ahead.
Hi. So the exits during the quarter at 0.7 million square feet seems to be quite high compared to the renewals of 0.2 million square feet. So what could explain this? Like you spoke about IT being weak during the quarter, but generally why the renewals have been quite low? And are we seeing enough demand from other segments to make up for these exits? Because the occupancy seems to have slightly fallen in the quarter.
So, of the 0.7 million square feet exits, we had a large occupier in excess of 0.5 million, which exited in our Galaxy Park in Noida for various reasons. As I mentioned, this is an asset which is in Sector 62 of Noida, where we are seeing significant amount of demand for this. So we're pretty confident of leasing up this space. If you look at the balance expiry for the year, I did cover one large potential exit which is coming up in Manyata. Again, a similar story, IT services. So overall, this is the reason, Pradyuman, for the exit what you're seeing. But at the same time, if you see the new lease-up which is happening, as well as the new lease-up which is projected, and what you're seeing in the overall market, it's a significant shift what you're seeing from IT services to GCC. Right? From our portfolio point of view, 55% plus now is in GCC. The first quarter lease-up, 70% plus is GCCs. And that's evident in all the research reports you're seeing in terms of how it is not just back office work which is coming to India, but it's value-added work. And as per the recent NASSCOM report, GCCs are now becoming the transformation hubs for their home centers, whichever country they are in. So overall, it's a shift in the occupier base for the entire industry. Bangalore, of course, is benefiting the most from this GCC. 34% of the overall headcount of GCC is located in Bangalore. 50% of the new GCCs set up last year were in Bangalore. So when you take all of this together, the shift is working out very well for us because, again, these guys are not very cost conscious. They don't mind paying the best rent for the best assets which we own.
Understood. And so what would explain the fall in occupancy considering the demand still is quite strong for the grade A offices? So why has there been a fall in occupancy, and are we seeing any kind of slowdown from any other segment apart from IT?
Yeah, Pradyuman, what you will continue to see for later part of this year is there will always be a gap, right, from a occupier leaving to a new tenant coming. So that will always be there, number one. Number two is, as we did mention in terms of GCC, what's happening is there is still last quarter you would have seen that the general average lease up would have been in the range of 50 to 100,000, but you have seen 2 large deals which have happened this year. Having said that, any large deal, even from a GCC point of view, it does take a little bit more time for the sign-off to come from global offices, including their global CEO, CFO, whoever might have to approve. So the decision might end up being a bit slower than what we want, causing this temporary gap in our occupancy.
Understood. And any other segments which are witnessing some sort of a slowdown apart from IT?
Not necessarily, Pradyuman, nothing to highlight.
All right. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good evening. My first question to you, Arvind, on any update on the Chennai ROFO asset, like where we are in terms of due diligence there?
Sure. Why don't I request Ritik to take this?
Yeah, sure. Thanks for the question, Kunal. Can you hear me okay?
Yeah.
Okay, great. Look, I think, like you said, the capital markets right now aren't necessarily conducive for us to pursue an acquisition sort of on the scale of where Chennai is. So we've actually put that process effectively on pause. I think that's no different from, where you see anybody with sort of a high cost of capital at this point in time in the market, relative to where the interest rate is and where stock prices are trading. As you know, we're dependent on that to actually fund an acquisition. And I think, while we have a lot of, time for the asset and we think it's a fabulous asset, it's just, difficult to think about sort of providing value to shareholders and doing it on an accretive basis. So we put the process on hold, and we will continue to be on the lookout to see if there's an opportunity to move forward. But at this point in time, that's been put on pause.
Sure. Thanks. My second question was on the guidance bit, right? I mean, when I look at your NOI and DPU guidance, the NOI guidance is about on the lower end of the guidance, right? With 29 billion of NOI on the lower end is actually higher than what you did last year. But on the DPU side, that again, the lower end is at about 20.5, which is significantly lower than last year's 21.7. So what are you estimating here in terms of, because NOI growth is not transmitting down to DPU for sure?
Yes, so this is Abhishek. So if you look at the NOI growth, what will happen is because of the 6 million square feet that we are assuming, the NOI is growing. However, there will be a drag from the interest cost, which we are estimating to increase by 15 to 18% over the previous year cost. Second is there will be non-cash NOI because of the difference between the dates of LCD and RCD. Some of this NOI will be non-cash for this year, and slight working capital change. So because of this, though NOI is growing, the DPU is not growing now.
So Kunal, a lot of this lease up which has happened this year will translate to full cash revenues ideally next year. So you would see a significant bump up in the cash distributions because of the current year lease up in next year, versus this year you will always have the non-cash gap.
Sure. Just on the debt bit, right? I mean, when we look at our expiries and, a substantial portion of our debt expiry over 24-25 is essentially fixed rate debt at about less than 6.5%. And the current repricing is like you said earlier, it's about 7.8%. So, is it like something that will just, like what I'm trying to understand, like the interest cost increase, would it settle down in FY24, or it will just again carry forward in FY25 also?
So, Kunal, again, what will happen is basically the 4,100 crores of NCD which is coming up for refi in the later half of this year will definitely increase the interest cost, and this is what we are saying when we are saying 2/3 of the total increase in interest cost of the current year will come from increasing the interest rates. 1/3 will come from the interest cost now hitting our PL because of the new deliveries that we'll do during the current year.
Yeah, look, Kunal, it's really, let me just add to this. I think, we look at sort of distributions quite pragmatically, right? At the end of the day, what happened for us is that, we've always faced a mildly elevated sort of interest rate environment in which we, I think, done, really well, given the fact that, we've traded effectively our debt in the mid-sevens, with the balance sheet that we have, which I think is, quite remarkable given all the volatility that we face, whether it's a pandemic, whether it's inflationary environment, right? Rates globally for REITs are backed up to almost like 2 or 3x what their people have been paying. We backed up probably like 100 basis points. Now, the reality is that is contributing to sort of a slight drag on distributions this next year. It is what it is. But I think, for calendar 24, and I'm not saying for calendar 24, not this refi, that the 4,100 crores of ETV vintage that we did at 6.5 that's coming up, which we'll probably get done in sort of a, we're pretty confident of getting that done competitively, but it will be elevated. We just want to be clear about that. But I think, the moment this rate cycle sort of, pauses, the moment we get, which, we think that hopefully this will be the last couple of hikes. But in that environment, that's what we meant by sort of the secular growth. We start thinking of the moment that moderates, I think you're going to sort of see a drop off both in rates and hopefully sort of as a lease up, this entire assumption that we've taken on comes to fruition, that should hopefully sort of lead to sort of a new distribution cycle. But look, we've always been very concerned about managing the balance sheet. We never want to take on more than we can chew for whether it's on development or the acquisition. The pipeline, our governance are sacrosanct, credit ratings are sacrosanct.
Hi, Auntie. Nice to see you as well. It's been so long. I'm good. How are you?
Somebody else is on mute, please. We're in the middle of a call.
Acha. Okay, hi.
I can hear you, yeah, but there's still some noise.
Yeah, no. Okay. Operator, can you just ensure that everybody else is on mute, please?
So everyone else is on mute. Only the main line and the current participant is unmuted.
Okay, that's fine. Let's move on. That's fine. But Kunal, I think the point I was just trying to make, I'll just reiterate that very quickly, is that, look, we think that we'll get this refi done fairly competitively, if more elevated than what we originally did it at. But CY24 should be a better year from a rate perspective, and that should flow into distributions.
Sure. Thanks so much. All the best.
Thank you, Kunal. Thank you.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks. Couple of questions. So firstly on the SEZ demand. So while we understand that it's weak because we are waiting an SEZ amendment and but just trying to understand how has it been for the last few quarters. So if you could give some color on in the gross leasing that we have been reporting, how much has been the SEZ leasing, and how has it been across various markets, let's say Bangalore, Pune, Noida. So that's the first question. Yeah.
Yeah, and just to take the SEZ in terms of, for us, when you look at Q1, the overall SEZ lease-up was around 45% of the total lease-up what we've done. And if I look at the market stats for Bangalore, I think it's a similar number, Mohit. Unfortunately, I don't have it handy as to what the SEZ demand was in other markets, but there is one interesting stat which I want to give out over here, which is when you look at our 16 million square feet of existing SEZ occupiers, close to 50% of those are GCCs. So what you could infer from is, as some of these GCCs expand who are already existing and have set up SEZ space and have some runway ahead of them in terms of the tax holiday period, there is a high chance that they'll continue to take space in SEZ, and that's largely what you have seen in the current quarter for us in terms of the M3 lease-up.
Okay, so even if, let's say, the much awaited amendment gets delayed, let's say, to next year after elections or something like that, even in that case, probably we'll continue to see the occupancy in the SEZ portion to ramp up. Is that understanding correct?
Yeah, I think there is still SEZ demand in Bangalore. Because, again, as I mentioned, when you correlate some of the stat with the growth in GCC, and some of them are existing GCCs as they're growing, we are seeing some of this take-up happening. That probably couldn't be the same for some of our other markets like Pune and Noida, because these are ITES markets, specifically micro markets where we are located. So need not necessarily be the same story for some of the other markets where floor-by-floor denotification would be important.
Okay, understood. And secondly, you mentioned in your opening remarks that the physical occupancy is improving. So again, could you give some color on where the portfolio is, and between GCCs and non-GCCs, how has that share changed?
Yeah, so I think this is a number which you could dissect in multiple ways. But a trend to look at more is on an overall basis portfolio level, I think the BTO is ranging from 52 to 54%. But when you look at the physical occupancy for some of our largest GCCs, it ranges from 75 to 80%, versus some of the ITES players are still hovering around, say, 25 to, say, 40%. So it's a mix of all these which culminate into this 52 to 54%, which is there on an average basis. But as GCCs grow, that's number one. Number two, as the ITES guys are calling more and more people back, this number on a blended basis should also go up for us.
Okay. Understood. Thanks a lot. That's all from my side.
Thank you, Mohit.
Thank you. The next question is from the line of Chetan from Kotak Securities. Please go ahead. So Chetan, your line is unmuted. You may please go ahead with your question.
Yeah, hi. So I think one of the questions already got asked and answered, I think. The second question which I wanted to ask was on Embassy Galaxy, where you mentioned that there is a large tenant who has vacated this quarter. I understand the in-place rental was low, and you are now mentioned that there is a strong pipeline to refill that. What are the rents you are targeting for this opportunity?
I think to keep it short, Chetan, we are looking at MTM spread ranging from, say, 30 to 40% to the in-place rental of that tenant.
Okay, understood. And time you are expecting to close by this quarter?
No, I think from a overall guidance perspective and assumptions what you factored, we believe a significant portion of this should be leased up during the course of the year.
Okay. So when you mentioned 30 to 40% over your existing in place, which was there earlier, so that comes to lower than the market rent today. Is that the right estimate?
So what will happen, Chetan, is if there is a small lease up, it will be similar to the market rent. If there is a large anchor tenant coming, it will of course be at some small discount to the market rate.
Okay, understood. Thank you.
Thank you. The next question is from the line of Satinder Singh Bedi from Eon Infotech. Please go ahead.
Why would anyone take SEZ? Yeah, that's it. Thanks.
Satinder, your line is unmuted. Please go ahead with your question.
Yes.
Mr. Satinder Bedi.
Yes, can you hear me, please?
Yeah, we can.
Okay. Yeah. Thanks for the opportunity and congratulations on a stable set of numbers, and must commend your disclosures, which are truly world class. I feel in line with what we get, let's say in Singapore or in US. My question. One question to Arvind. Arvind, what are the top 3 concerns that you have as CEO that bother you today?
Sure, Satinder. I think let me keep it simple. Instead of answering it as top 3 concern, honestly, it's only one concern, which is a simple short-term goal for us is to increase the occupancy. The way I look at it, our business model is very simple. I am able to increase the occupancy, our cash flows go up, distributions go up, which logically should take the price up, which will enable us to grow inorganically as well, because we are going to use equity as well as debt to grow. So on an overall basis, we are looking at increasing the lease up, so the simple short-term focus is to increase lease up, increase distributions. Of course, we do have the organic 7.9 million square feet which we are developing over and above the existing vacant area which we can lease up, which will add to the organic growth story. So that's the way we are looking at, or I'm looking at it, Satinder, to just focus on increasing the overall occupancy.
Okay. And Arvind, on this, probably I missed it. Okay, maybe this got answered earlier. Last quarter, you said that the absence of large deal inquiries is some concern. So has the momentum shifted on that over the last 3 months, or is it still the same as it was a quarter ago?
So honestly, Satinder, the way we are seeing is, you have seen that we've done 2 reasonably large deals this quarter. There are some significant RFPs in the market which we have participated, and these are large deals. Having said that, it is certain that these guys need to take up this space. But while, because of the size of these deals, when they do go to their home country for approval, it takes them more time because the situation in the respective home country is much different than what it is in India. So the deal making still takes a bit more time than what it used to take, let's say, a few years back. But slowly we are seeing traction the way you've seen in our Q1, some of the lead up.
Okay. And what? So there's a significant part of pre-lease commitment. So just wanted to understand what does it take in terms of pre-lease commitment? How much is the future tenant's skin in the game? Is it 6 months of security deposit, or what kind of commitment does he have when he pre-commits?
Sorry, Satinder, we couldn't. You're talking about security deposit?
So there are pre-lease commitments. So significant part of the leasing is pre-lease commitments. So pre-lease commitments obviously are forward commitments. So, but it's a commitment made today. So we wanted to understand as to what is the nature of this commitment. What kind of a commitment does he put up front? Okay, is it just a contract, or is it a security commitment, or I don't know?
Yeah. So typically, what happens is they enter into letter of intent and they do place some amount of security deposits. That's typically how the pre-lease commitments work.
Okay, fine. Thank you. And one final question from Abhishek. Abhishek, this EGL distribution, okay, can you just help us understand how is this worked out, this 567 million? So from EGL, we get 2 lines of revenue. One is the dividend, which we understand is the profit as a 50% owner of the EGL asset. And second is distribution from Embassy Golf Lake. So how is this 567 arrived at for this quarter?
So, the total receipt that we have from EGL is 80 crores for this quarter, which basically includes dividend, that is one, which is 23 crores. Yeah. The next 2 parts is basically, if you remember, we had actually invested in their NCD for acquisition of some building. Yeah. So the second is interest on that debt, which is again 17 crores for this current quarter. And the balance, 40 crores, is the return of this debt, which is amount of debt component. So total is 80 crores.
This is the 567.
Excuse me, sir. I am so sorry to interrupt. May I please request you to rejoin the queue for your follow-up as we have people waiting for you.
It's fine. It's okay. Satwinder, please go ahead. It's fine.
Yeah. Okay. So this 233, the NCDs is 567?
No, Satwinder, what happens is there are three components, right? One is dividend,
which is there.
Yeah, dividend is 23 crores, which is not there in the 567.
Yeah, so that's right, 233. Yeah, 233 billion.
Yeah, so balance is 567 is basically interest and the amount of settlement. Yeah.
Okay, fine. Thank you. I'll come back in the queue for one more question. Thank you.
Thank you. The next question is from the line of Abhishek Khanna from Kotak Institutional Equities. Please go ahead.
Hi, I just had two clarifications. One, you said of the 60-40 breakup in your total SEZ, non-SEZ area, is the breakup of your vacant area also the same, 60-40?
Just give us a second, Abhishek. Why don't you ask your second question in the meantime?
That is the first one. Second, I just wanted to clarify, when you say you leased out 0.5 million square feet of SEZ area in the current quarter, is it all to the tenants who were already occupying that area? I mean, these are all existing SEZ tenants. Is that how it works? Because I assume nobody would be, as a tenant, taking up new SEZ space. Is that understanding correct?
Yeah, that's correct. It's an expansion of existing guys. So the answer to the second question is it is existing guys.
All 0.5 million square feet, right?
Yeah. Going back to your first question, I think it's a similar percentage, around 60-40.
So it's 85% vacancy essentially for both SEZ and non-SEZ areas, broadly.
It's a small marginal difference, 85 and 86. 85 is the SEZ occupancy, 86 is non-SEZ occupancy.
Fair enough. Got it. Thanks a lot.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of Embassy REIT, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.